Biotech has posted a mixed set of Q4 numbers. The company has reported a healthy operating profit margin, but revenues have slipped 7% on a year-on-year basis. Sunil Chari, the co-founder and managing director at Rossari Biotech, is with us on the show. Sir, we'll get to your top-line performance. Before that, on margins, is there scope for margin improvement from current levels?
Yes, this year our focus is to increase the absolute amount of EBITDA, and we are confident of growing the absolute amount of EBITDA rather than focusing on top line or EBITDA as a percentage of sales. We should be able to grow EBITDA as an absolute amount in a good way.
Any number on the absolute EBITDA? FY23 was 223 crore.
Yes, so we expect, we grew well last year in terms of absolute EBITDA, and we expect the absolute EBITDA to grow this year also, at least in the range of about 20% plus.
Okay, 20% plus. So you had actually guided for EBITDA of around 250 crore rupees, revenues of around 2,000 crore rupees. You've fallen short of it slightly. Can you explain what the reason is and what kind of revenue numbers are you looking for as far as FY24 is concerned?
There were three setbacks which we had last year. One was the Ukraine war, which we did not predict. The second one was the forex crisis in many countries where we wanted to export. Third one was the textile. Our textile customers had a lot of headwinds in the past 2 quarters. This, contributed. So if you see year-on-year growth, we have grown well, on a consolidated level, both on top line and both on EBITDA as well. And I expect this year our exports have grown well. We are nearly at 380 crores of export now compared to 263 crores of export in the last year. And we expect the exports to grow further.
But revenues are under pressure for the factors that you did mention. Even in the month of April, have we continued to see a decline in the top line? And any guidance for the full year for the top line?
In fact, if you see, 21-22 and 22-23, the raw material prices had surged in 21-22. Compared to 22-23, they are now not exactly near, pre-COVID levels, but they are substantially lower than 21-22. So 22-23, we are happy because if you see per kilo sales value, it has fallen. We had some key raw materials, for example, acetic acid, which was at 100 rupees average in 21-22. It came down to 40 rupees average now. So the selling prices, of course, of our finished goods will go, fall lower than this. So we don't see, degrowth. We have seen, I think, growth in terms of average selling price per kilo.
Okay. So since raw material prices have fallen, you've passed it on to your customers. That's why revenue growth has been lower, or it has actually fallen on a YOY basis. That explains that. Can you tell us the outlook for all the 3 segments? Because this time around, if I look at it, your HPPC segment, or the Home Personal Care and Performance Chemicals, is down both on a YOY and on a quarter-on-quarter basis, while Animal Health and Nutrition has done really well. Textile Specialty Chemicals has seen some recovery on a quarter-on-quarter basis. What is the outlook on all 3 of them? Which is going to be, what kind of growth rates are you anticipating in all 3 of them? Which is the highest margin segment for you?
So if you see 3 years back when we did our IPO and we listed on the stock exchanges, our HPPC segment was nearly 50%. And if you see the consolidated sales for 22-23, it is nearly 70%. We expect the HPPC segment to continuously grow. Textiles, we see a muted growth. Of course, we should see growth in textile because we see a recovery in the second half of this financial year. AHN will continue to grow because it is a small base. So I think the ratio of 70, 20 and 10 should be, a good indicator of what could happen in this year.
Okay, that's for the next year, 70, 20 and 10. 70% revenue contribution from HPCP, Home Personal Care and Performance, 20% from Textile Specialty Chemicals and 10% from Animal Health and Nutrition. How can this ratio change, sir, going ahead in the next 5 years?
So we should see growth both in HPPC and in textile substantially. So textile will continue to grow, but not at the same speed as HPPC and AHN. So I think HPPC should be more than 75% if you see 5 years from now.
Is the HPPC margin higher than the other 2 segments? What is the margin picture like?
We are not able to, work out EBITDA margins segment-wise, but normally gross margins are, the best in animals and nutrition, and followed by HPPC, and third is by textile industry.
Okay. Can you also give us a sense of what the current capacity utilization is? With all the acquisitions that you've made, what does it stand at? What is the capacity utilization? Will you be able to scale it up further? And considering that, what kind of revenue growth are you expecting, say, 2 to 3 years down the line? Because you did say you're expecting gross asset turn of around 5 to 6 times by FY24. What is the current gross block?
See, in terms of the capacity utilization, it is around about 50 to 60%. So to grow to 3,000, 4,000 crores, we do not anticipate any big amount of capex. We may require 30, 40, 50 crores of maintenance or new, debottling capex. So we should be able to grow because we have substantial capacity, available. In terms of gross block, it is about 240 crore rupees, and the net asset is now nearing 1,000 crores.
Okay. What's the driver for this EBITDA growth of more than 20% for FY24?
We did a change in product mix, and we focused on high margin products, and this has resulted. And also, if you see, the raw material prices have fallen, and when raw material prices fall, the EBITDA margins automatically increase, because we are not able to increase. For example, 21-22 and 22-23, the raw material prices went up by nearly 50%, and we could not increase our EBITDA margin as a percentage by 50%. And we have to be fair to our customers, and we focus on the absolute amount of EBITDA, and which we have grown substantially at 223 crores. We are highest ever in our history. And with our financial working capital ratios, we have seen a very healthy balance of growth with recoveries and cash flow.
So, Mr. Chari, can you leave us with what your plans with the cash in books is? Around 77 crore rupees is what you have in your books. Any other acquisition, any way to reward your shareholders? Is anything in the pipeline?
As a growing company, the company continuously needs funds. So, we declared 25% dividend this year, and we have been declaring dividend for all the last 25 years since we are in operations. And we will look at as we grow further, we need to have some cash on our books. That is what is the plan.
Okay. We leave it at that there, Mr. Chari. Thank you very much for joining in. That's Rossari Biotech guiding for a 20% growth in the company's EBITDA in FY24. HPPC segment will continue to grow. Next year, it should contribute 70% to the top line, which will further increase to 75% in the next 5 years. Let's slip into a break. On the other side, Patanjali Keswani,